We are working on the operating activity section of the statement of cash flow using the indirect method approach. So we're looking at right now what items are we going to add to our accrual-based net income in order to calculate our cash-based net income. So any types of non-cash expenses such as depreciation will be added back into our accrual-based net income. If we have a loss on disposal of a planned asset, that will also be added back into the accrual-based net income to calculate our cash-based net income. Okay? We'll now take a look at our changes in our non-cash current assets. Again, the key word being non-cash current assets, such as account receivable. From the comparative balance sheet, it showed the beginning balance, which was $30,000, It shows the ending balance, which is $20,000. So we can see that the account receivable count decreased by $10,000 during the course of the accounting period. So you want to ask yourself what would cause the account receivable count to decrease. It means that the amount of cash collected from customers was higher than the actual sales for that same time period. So again, if the account receivable balance decreased, that means the amount of cash collected for the accounting period was greater than the amount of sales revenue recognized for that accounting period. And again, we're focused on converting to a cash-based net income. Under the cash basis of accounting, again, you recognize revenue once cash has been received. We can see from this illustration, sales revenue on the income statement total $507,000. Get my cursor right, there we go. But the actual cash collected was $517,000. Okay, so the $10,000 difference, we're going to add that back into our accrual-based net income to convert to your cash-based net income. Because again, under the cash basis, you report income once cash has been received. Okay? So we're going to add that $10,000 back into the accrual-based net income to calculate your cash-based net income. We'll then look at inventory, which is another non-cash current asset. Beginning balance was $10,000. The ending balance was $15,000, which means that the inventory account increased by $5,000 from the beginning of the accounting period until the end of the accounting period. So now you're going to ask yourself, what will cause the inventory account to increase? It means that we purchased more inventory than what we sold during the course of the accounting period. Again, we purchased more inventory than what we sold during the course of the accounting period. So, again, we're focused on a cash-based net income. Under the cash basis, whenever cash is spent on items such as purchases, it will be shown on the income statement. But on the accrual basis, it's not until we actually sold the inventory do you record it as an actual expense. Remember again, your goal is to convert from an accrual-based net income over to a cash-based net income. Anytime you have an increase in a non-cash current asset, subtract that from your accrual-based net income to calculate your cash-based net income. Again, anytime you have an increase in a non-cash current asset, subtract that increase from your accrual-based net income to get your cash-based net income. So the $5,000 increase in inventory is being subtracted from the accrual-based net income to calculate our cash-based net income. Next, you have your prepaid expenses, which are also non-cash current assets. It's the same concept. If you have an increase in prepaid expenses, it means that cash paid for the period was higher than the expenses reported on the income statement under the accrual basis of accounting. If prepaid expenses have decreased, it means the expense reported on the income statement are higher than the actual expenses paid for the accounting period. Whenever you have an increase in any non-cash current asset, deduct that from the accrual-based net income to get your cash-based net income. Whenever you have a decrease in any prepaid expenses, you're going to add the decrease to your accrual-based net income to determine your cash-based net income. So for our illustration, we had an increase in prepaid expenses by $4,000. Therefore, that increase is subtracted from our accrual-based net income to determine our cash-based net income. Changes in your current liabilities. These changes have a direct impact on the increase or decrease in your from the accrual-based net income to your cash-based net income. Let's simplify it. If we have an increase in accounts payable or any type of current liability, it means that the expenses shown on the income statement are higher than the actual amount of cash paid out. Again, anytime you have an increase in a current liability, it means the expenses on the income statement are higher than the actual amount of cash paid out. Think about your income taxes. If I haven't paid all of my income taxes, you would debit income tax expense and credit income tax payable. The payable account will only increase if the amount of cash paid for the expenses was less than the actual amount of the expense. So when you have an increase in your current liabilities, you're going to add that increase to your accrual-based net income to calculate your cash-based net income. If you have a decrease in a current liability, subtract the decrease in the current liability from your accrual-based net income to your cash-based net income. All right, so for our illustration, we had an increase in accounts payable. We're going to add the increase to our accrual-based net income to determine our cash-based net income. We had a decrease in income tax payable. Subtract the decrease in income tax payable from your accrual-based net income to get to your cash-based net income. Okay, so let's recap. When preparing the statement of cash flow using the indirect method, you first begin with your accrual-based net income reflected on your income statement. You're then going to add any type of non-cash expenses such as depreciation, amortization, or depletion. You'll then look at the income statement to see if there was a loss or a gain on disposal of a planned asset. If you have a loss on disposal of a planned asset, you're going to add that amount to your accrual-based net income. If there's a gain on disposal of planned asset, subtract that amount to get your cash-based net income. Next, look at all of your non-cash current assets. If you have a decrease in a non-cash current asset, you're going to add the amount of the decrease. If you have an increase in a non-cash current asset, you're going to subtract the amount of the increase. And then last, you'll look at your current liabilities. If you have an increase in the current liability, you're going to add that amount. If there's a decrease in a non-current liability, you're going to subtract that amount. So when you put things all together on our statement of cash flow using the indirect method, on the income statement, we show net income $145,000. That was using the accrued base of income. But the net cash we would have shown under the cash basis would have been $172,000. We converted from an accrued based net income over to a cash based net income. So overall, write this number down. The net cash provided from operating activities total $172,000. Okay? So this is just a summary of indicating whether an amount should be added or subtracted from the accrued based net income to get to your cash based net income. Now, if needed, write down these rules so you'll know whether an amount should be added or subtracted from your accrued based net income to determine your cash based net income. We'll now look at the investing activities section of the statement of cash flow. Again, the investing activities section of the statement of cash flow. When you think about your investing activities, you're now focused on, again, your long-term assets, such as your property, plant, and equipment assets, any long-term investments, and any intangible assets. For example, when you look at the comparative balance sheets for the building account, it showed the building beginning balance was $40,000. The ending balance was $160,000. So what does that mean? It means that we acquired buildings for $120,000 in cash. That's going to be an outflow up under the investing activities section of the statement of cash flow because we spend cash to acquire a new building. All right? Look at our equipment. For our equipment, we had two transactions. We purchased equipment for $25,000, and then we sold equipment for $4,000 that initially cost us $8,000. So we know a few things. The loss on disposal of planned asset, we record that already, a loss of $3,000. Why is it $3,000? Well, because the equipment cost us $8,000. So far, we had depreciated $1,000. So the equipment had a book value of $7,000, cost less depreciation, but we only sold it for $4,000. So that loss of $3,000, we recorded already on the operating activities section of the statement of cash flow. All right? So to give you time to ponder that information, we're going to come back and conclude our discussion on how to prepare the statement of cash flow.